Hi, I'm Richard Murphy, and this is the 16th in the video series on the importance of tax transparency that I will be hosting, and which is being made jointly by the University of Sheffield, where I work as Professor of Accounting Practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, we explore the importance of being transparent about income taxes. Few states can survive without an income tax, so planning one transparently is essential. Income taxes are usually charged on the following items when received by an individual: employment income, profits from trade, whether trading alone or in partnership, pensions, rents, investment income of all sorts, income from trusts and settlements. They might also be charged on profits arising from the sale of assets owned by an individual, but these are commonly charged to a capital gains tax or are not subject to tax at all. The profits of companies from any source, but these are usually subject to a corporation tax. And the receipt of gifts, although that is unusual. Because few other taxes have the potential breadth of scope of an income tax, a state needs to be transparent about its planning for any such tax that it proposes. It does, in particular, need to be clear about its capacity to identify those with income that might be subject to tax, its ability to make them pay tax on their income, the problems any state faces in identifying income from self-employment and then taxing it, the role of withholding taxes in income tax collection, particularly on income derived from employment, savings and wealth, mechanisms for addressing capital flight outside the country and the resulting risk of income loss, the extent to which income tax can play a role in social policy in the jurisdiction, and how income tax payment is best managed within the jurisdiction. Each issue should focus on the capacity to tax. In other words, the need to balance the demand for revenue with the actual ability to collect it has always to be at the forefront of income tax design in any jurisdiction, whatever its size and experience with such taxes. The goals of the state's tax strategy also have to always be borne in mind, most especially if this has been designed in cooperation with the relevant interest of parties in its communities, with the role of transparency and public engagement always being highlighted. In this context, this will require a particular focus on tax morale, because this represents the willingness of any community to pay taxes and the confidence people have in the tax system as a whole, and its procedures, openness, and fairness. The higher tax morale is, the greater the willingness people will have to pay tax. And tax transparency and public participation do, in our opinion, and as shown by several studies, typically deliver higher tax morale. It is important as a result to determine if there are some communities that cannot or are unlikely to be persuaded to pay income taxes, so that attempting to collect tax from them is of little benefit, especially to tax morale. We discussed this issue in more depth in videos 11 and 12. Consideration of all these issues is usually complex within high-income countries. Many of them take on quite different perspectives in low-income countries or those with populations with very high disparities of income, as is also more common in lower-income countries. In these countries, the usual narratives about the difficulty of tracking taxpayers, determining their incomes, and facing the difficulties of collecting any sums owing have to be supplemented by some additional concerns common to these countries. In particular, the following issues have to be considered. Larger proportions of people tend to be self-employed in lower income countries, often earning very low incomes. This is especially true for women and other marginalized members of society. Rates of illiteracy are also generally, but not always, higher in lower income countries than those in higher income countries. The assumption that business records can be kept by all those who are self-employed is misplaced in many cases as a result. This is again on occasion a gender issue because of the difficulties many girls, women and other marginalized members of society have in accessing formal education. In addition, given the smaller proportion of the population in employment, the collection of tax from those in that situation using pay-as-you-earn, or PAYE, wage deduction schemes by withholding payments at source is likely to be much less effective in lower income countries. Also, the number of people with significant investment income is low in many lower income countries, meaning that these taxes should be designed to exempt from reporting requirements all those who are likely to have no obligation to pay taxes of these sorts. It is also important to note that if tax exemptions, reliefs and allowances are to be provided, the aim should be to make these as easy as possible to understand, simple to apply, as free from the possibility of abuse as possible, and as easy to apply for as possible for those who might be able to take advantage of them. Transparency on these issues is vital if tax morale is to be maintained. Transparent mechanisms to address these issues should focus on the following. Firstly, exempting income from self-employment that is likely to deliver nothing more than the modest level of income from tax. This limit may need to vary regionally in some jurisdictions where geographic disparities in income are high. Secondly, exempting the level of investment income most people in the country are likely to enjoy from income taxes. Thirdly, only applying PAYE income tax arrangements requiring the tax be deducted from payments to employees in businesses where it is likely that persons with higher levels of income will be employed. Fourthly, explaining what records, if any, are required to be maintained to prove qualification for these exemptions. Problems will only usually arise for those individuals and companies who are on the margins of being liable for tax, and these will be usually relatively few in number. It is then vital that appropriate tax collection systems be put in place. To be effective, these will usually require that, firstly, a pay-as-you-earn system for the collection of tax due on account by employees is in operation and applied by those larger companies likely to have employees with sufficient income for this to be appropriate. Secondly, a system for tax deduction at source is in operation for investment income. For example, interest payments above an agreed amount should be subject to tax deduction at source, and dividend payments might also be subject to similar arrangements if paid to individuals. Thirdly, systems of automatic information exchange with banks operating in the jurisdiction should be put in place so that the following are likely to be notified by them to the tax authority each year. Likely self-employed income arising in a year if above an agreed limit. Likely rental income arising in a year, again, if above an agreed limit. Unidentified deposits above an agreed sum each year. The banks in question should be required to do no more than advise total figures. It is for the tax authority to pursue the matter if they wish to do so once notification has taken place. The above arrangements should all be explained so that taxpayers are aware that a tax authority might have the information required to monitor the income that they declare. Systems to identify the beneficial owners of companies and trusts may be required to make these arrangements work. These can be complicated, as bank cooperation may not always be forthcoming. Hence, it should be legally required in all licensed banks in a jurisdiction. It is also vital that a tax authority also partake in international automatic information exchange arrangements to the greatest possible degree to ensure that they can determine the worldwide income of those living in their jurisdiction if they decide that this should be subject to tax. Cooperation with the Organization for Economic Cooperation and Development, the OECD, on such issues is vital as a result. One final aspect of income tax system design is really important. The tax authority of a jurisdiction should be funded so that it has the resources required to identify those with taxable income, tax to be collected, those whose tax affairs require investigation. It also needs to be funded to pursue tax investigations through the legal system if required, maintain a tax presence in all major centres of population in a jurisdiction, and deliver all the necessary components of a tax system when it comes to income tax. No income tax system is ever perfect, and what works in one jurisdiction may not work in another. What is proposed should be the starting point for developing tax transparency around this vital tax.